Welcome to the Private Lender Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, thanks for checking out the Private Lenders Podcast. Chris and Jason here as always. And as always, we are sponsored by our mastermind group, online mastermind for private and hard money lenders, hardmoneymastermind.com. So check it out, create a free account, join the conversation, check out the content, training, everything else. Okay, today we're talking about borrower quality, underwriting borrowers to predict how likely it is they're going to perform on this real estate investment project. And after, thousands of loans, 15 years of experience, you see a lot. You see what happens with the stronger ones, with the weaker ones, and then kind of, make a judgment call on the ones in between and how they play out. And you get to a point where you can predict things pretty well based on what they look like up front. Isn't that right?
Oh, absolutely. And we're in an interesting spot in the market right now because obviously real estate's appreciated a lot over the last, 10 years. It's kind of been a bull market and it's appreciated a lot. And just because you necessarily are lending against a good asset, obviously collateral is the most important thing, right? You have to be, we don't do unsecured loans. We're doing secured first position loans. Collateral is the most important thing. But just because you have a good piece of collateral doesn't necessarily mean that the borrower is going to perform. And we're going to go through a few examples today. So, let's say you have a $400,000 property free and clear and the borrower needs $100,000, right? That's a good collateral based loan, but there's other things to look out for to make sure the borrower, the client, the person that is making monthly payments, has the ability and has the capacity to perform. So let's go through a few real quick. So things to look for a borrower is obviously, do they have good credit? Do they have experience? Do they have, good skin in the game? Are they able to contribute their own capital into this deal? Do they have the capacity to perform? Do they have positive characteristics? Like, do they communicate? Are they hungry to be able to accomplish this project? Do they answer your phone calls when you speak to them? Do they do that in a timely manner? So all of those things are taken into consideration. And although collateral is the most important thing, if the borrower does not have good character, capacity, and maybe even credit, other safeguards should be put in place to make sure the deal still works, right? The deal still makes sense. Now, I'm not stating that you shouldn't do a $100,000 loan on a $400,000 as is asset at all, but you do need to be aware of other circumstances besides just, hey, this is a good collateral piece. I feel like years back, people would use the term loan to own, right? And you go into a project stating, oh, well, I'll just loan the borrower whatever I'd be willing to pay for myself, buy the property for myself. And that's my metrics. Unfortunately, that's not a great metrics, and especially determines on a default state where jurisdiction you live in, right? Because some states take a long time to foreclose and attorney costs could be high to do so. So, just because you want to, let's say, oh, I'd be willing to pay $200,000 for this property, so I'll lend $200,000 and it's worth whatever, $300,000. Well, guess what? By the time, that deal goes sideways, it's not $200,000 anymore. It's significantly higher than that. And all of that can be prevented and eliminated by lending to good quality borrowers that will perform, and it'll make your life so much easier. Like, that's the business model. Lend on good collateral to the right borrowers that will perform, make your monthly payments, and get paid off and move that to the next project.
Yeah, I'm glad you used the term client earlier because few points on that. So in the lending industry, borrower is a very common term. And internally, we use it for sure. We try not to use it too much when communicating with the borrower because I don't think that's just a great term to name someone who you're doing business with. Like, you're a borrower, you borrow money. That's what you do. It's not like the best connotation as opposed to client, which is a better way to approach the relationship. A client has status. A client is somebody you want to wine and dine. A client is someone that you're looking to have a business relationship with and do many deals over many years. That's the goal, right? And sometimes, I mean, you can start to pinpoint like the folks that you're lending money to. Like, is this like a client that I know is going to be around and I want to be in business with, and I'm going to spend marketing dollars to find, versus, you know, a lower quality borrower doing a real estate deal. We don't know exactly how it's going to work out, but we'll be in a safe position, that sort of thing, that distinction, right? So we think about that all the time and we discuss it internally, and we're looking at, and there's a lot of people in the middle. There's a lot of gray areas. Like there's somewhere in between that, like, you know, this is a home run borrower, a home run client that I want to work with for a long time, and like low quality. They're in between, and you don't know exactly how it's going to work out. And sometimes people perform better than you think, and then sometimes the opposite is true. And a lot of this has to do with construction. You know, it's not the only aspect to the real estate deals that we do, but many of them do have construction components, specifically like in the residential fix and flip investing world. It's not easy to get $100,000 construction project done. That's not something that anybody can just walk into a property and run those jobs, run those subcontractors the right way, right? So like if you see somebody who doesn't appear to operate well in life for the most part, you know, in terms of you know, what the credit situation looks like, financial, business history, where they live, if they don't seem to be operating that very well, it's safe to say they're not going to operate a construction project well either. They just don't operate well.
Yeah.
And that sounds a little harsh, but it's just a reality of real estate investing and how we fit into it. You know what I mean? So like, yeah, again, somebody owns a piece of property, maybe they inherited it. They're not like a skilled real estate investor, but we're doing for $100K on a $400K asset, like we'll be fine. But it's a different story when you're talking about like construction projects and like 65 ARV, all that stuff.
Well, it's hard to perform. It's hard to flip a house. You know, a lot of people don't realize that. And I taught, you know, both of us talk to a lot of private lenders and hard money lenders throughout the country. We have a lot in our Hard Money Mastermind group that we field questions for and talk to and communicate with and stuff like that. And I always feel like they don't devote enough time to underwriting the borrower, mostly just the collateral. And again, the collateral is the biggest thing. You know, if you follow our four C's, it's, you know, collateral is number one, the character of the borrower is number two, capacity is number three, and credit's number four. So all of that stuff is important. And collateral is obviously the most important. If there's no collateral, you don't pass go. There's no point to do anything else. But you gotta to make sure the borrower has the ability and is willing to be able to execute on this project. Cash is king, obviously, right? What's stronger, $100,000 project with, you know, what's better? A borrower bringing $40,000 to the table or $60,000 to the table, right? The more they bring to the table, the more vested they're in, especially right now. You know, if you're out there actively lending and quoting deals, you probably know that the cash to close is significantly higher over the last 4 or 5 months as the market shifted than it was, you know, a year ago. You know, we haven't really done 100% financing in a while, but over the last few years, a lot of our stuff was 75 to 80% of the acquisition, 100% of construction. You know, so the borrower would need, you know, about 25% cash to close, maybe a little bit more between down payment and closing costs, 25, 30%. And that number is higher now. And it's a lot of money that they need. But mostly that's just because, you know, the quality and the types of deals that are out there. So related to, you know, the capacity, like we talked about with these borrowers is, you know, and again, it could be a first-time borrower that doesn't, or a client. That's not a big deal, but like meet them. Make sure you meet all of your clients. That's a good way to do it. And the easiest way to do it is you're going out to look at the property anyways. So when you go out to look at the asset and the property, meet the borrower, talk to them. Did they show up on time? You know, if you know, they're not showing up on time, they're probably not gonna be making payments to you on time. Make sure they take it seriously. So I don't know. It's kind of like a little pet peeve for me that like when I talk to some private lenders throughout the country and I ask them questions about the borrower, they're like, oh, I don't really know what their credit is, or I don't know how much cash, you know, they can put in, or I don't know this. Like those are questions that you got to ask up front. Mm-hmm. And again, let's say somebody has a 580 credit score, right? Not ideal, low. Does that mean you turn the deal down completely? Does that mean that, yeah, whatever, what does it matter? It's a collateral based loan. Who cares what their credit is? Well, guess what? Someone with higher credit scores have they have a better capacity. They have other options if a deal starts going sideways, right? They're credit worthy that, let's say a deal goes sideways or they go over the construction budget, they could get a HELOC on their home. They could probably do credit card. They probably get money on credit card. They can get lines of credit. They can get someone else to refinance them if needed. If their credit scores are lower, it doesn't mean you don't do the deal at all, but you got to underwrite that accordingly, because they might, if they run into problems and they run out of cash, they might not be able to have means to get additional capital. And they certainly can't refinance with the bank with that credit score. So those are all things that have to be taken in consideration when you're doing these deals. I'll tell you that the majority of the clients that we lend to are close to bankable, if not bankable. Mm-hmm. That doesn't mean that we're asking for tax returns or W-2s or things like that, but they have good credit. They have lots of cash. They know what they're doing. Or some of them on the lower end side, they can be. And if they are, it better be a good piece of collateral and they better be bringing more of a down payment, right? They have to have another compensating factor.
Yeah. I mean, if there are private lenders out there listening to this or checking it out in the mastermind group that don't get any kind of credit report, I'd be very worried. Like, honestly, it tells a lot about people's history and how they operate in general. So like, 3 things that I would look at to determine like borrower strength is credit, and it's cash. Get a bank statement. It can be a screenshot. It can be whatever. Like, we don't have to have every page of it. Like, we're not a bank, but like business account, personal account, whatever. If you see some assets, chances are they're operating pretty well. And then one of the first things I look at when I'm like double checking a file from someone in our team on a deal we're about to close, I look at their home address. I check out the home address and see where they live. And that, again, will tell you something about a person and what they're up to and how they operate. On occasion, we've even done background checks, when we're on certain kinds of loans. And if we're unsure of borrower quality and just want to have another check in there, we've done a pretty easy and inexpensive background check through, I think it's clearchecks.com. So that's an option too. Anyone can do it. The borrower has to agree to it via email. Anyway, just a number of thoughts we've had on borrower quality. We talk about it with our team every week, easily, like looking at people and before and afters. Like when you do a lot of loans and you have a decent sized portfolio, you see the conversations that you had up front about X borrower and how they're going to operate and who ends up in the default being discussed in the default meeting. So like you can't over time, you get a very good sense of what's going to happen.
Well, the defaulted deals are typically the lower quality borrowers.
Yeah,
clients.
And the lower dollar areas and the lower dollar loan amounts.
Yeah, and that's what happens. I mean, listen, the market hasn't really shifted that much, right? It hasn't declined in value. So for somebody who's qualified, they have the ability to get out. They can either execute and they can figure out ways to get the property sold, get it completely renovated and sold, or if they want to hold it as a rental, they have the ability to get a bank to refinance them or institutional lender to refinance them. If they're not that savvy in general, they're going to have a hard time navigating that. I mean, who wants to pay 12.99% interest rate for long periods of time? Like, that's what our rates are, right? They want to get out as quick as possible and move so. So, if you have deals that are kind of sitting in limbo on the books right now, try to figure out ways to push those along with your clients. And again, this isn't like a conversation about, hey, you got to have good credit and this. Like, there's exceptions to all these rules, but we will tell you from experience that clients with lower credit scores and high construction budgets typically default, right? They already have a hard time mismanaging their finances because their credit's lower. And let's be honest, it doesn't matter how many projects you've done, how much money you have. $100,000 construction project is big and stuff gets botched up and things happen. And if you're dealing with a higher quality client, they can navigate a project like that. And when they run into problems, they can figure out a solution. Lower quality, less experienced clients have a harder time doing that.
Yeah, when they run into trouble, they don't know how to handle it. They don't know how to handle it. And so instead of handling a project that needs to be completed or like exited or whatever, they might just walk away. They might just go hide. And then it becomes your problem. So that's what we're trying to avoid here. Like getting to the people who are going to, in all likelihood, complete the project, get it on the market. Or if things go a little sideways, they're savvy enough to know how to navigate a situation like that. That's who we're looking for. And when we do find them, we put a lot into taking care of these people. We want them around. We want them to be clients. Like, come by the office. We used to do lunches back in the day, like, pre-pandemic and all that stuff. We would have most every Friday a client come in for a lunch with the team. We'd have a chef cater it. Like, we're putting effort into nurturing those relationships with the right people and trying to find more of those right people, and keeping our portfolio away from the bad people, because they'll take a okay situation and make it a bad one.
Yeah, they'll bring it down. A good client will take a marginal deal and turn it into something. And we've seen a lot of bad clients take a really good deal and turn it into crap. That's just it. Like, so just kind of be careful on that. And I get the question all the time of, well, would you lend to a first-time borrower? Absolutely. Or first-time client or a first-time deal flipper? Absolutely. We've had a lot of success, but again, if they haven't done a deal, because I know that used to, back in the day when institutional lenders were around, I remember a lot of them would make them, they couldn't do first-time real estate investors. They had to have a few deals that they funded. They have to do like 3 deals or whatever in experience. We don't care about that. We've had a lot of success working with newer real estate investors because if they have a past history of being successful. Do they have a good job that they've been at for a while? Do they have cash to contribute? Have they gone through a mentorship or a program that they've taken seriously? There's a lot of really good real estate investors out there that are just getting into it. And I feel like with some of them, and it's hard to hold everybody's hand, obviously, but you got to kind of, have a good gut feel instinct of who's that right person. And, you work with them typically, maybe they have to bring more cash to close up front, and they have that ability to, and, those deals work out. We've had a lot of success with that. And, would I recommend they do a humongous construction project? Absolutely not. But there's still a lot of good lipstick on a pig projects out there, or there's deals that just don't have major renovations that they can get in and out on. And maybe they don't make a ton of money on that deal because they fumble through it, but you structure it to make it very, very low risk for you as a lender.
Yep. All right. Good stuff. I like that topic. That's why we touch on it pretty frequently, because it is important. It's a factor every day in your lending business. Hopefully you guys are doing the right thing and documenting your files in the right way, so you know exactly what's going on with both the borrower and the property. Hope this was some value to you if you're listening to this, or if you are watching it inside the mastermind group. Feel free to comment, share, send it to somebody else, anyone who you think might benefit from this information. Leave us a review. We really appreciate it. We'll see you next time here on the Private Lenders Podcast. And as always, go check out hardmoneymastermind.com.
Thanks, guys.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you'd enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard